In this video, I'm going to cover the entry-level technical analysis and why it works for me. Now, real quick, I'm not a financial advisor, so this isn't financial advice. Consider it an educational video for entertainment purposes only. Nor am I recommending to buy or sell any stocks that I talk about today. So real quick, there's a group of people out there that believe technical analysis doesn't work because they think it's tea leaf reading, they think it's crystal balling. But for me, technical analysis is about risk management. It's about identifying good entries and appropriate exits to maximize my risk to reward ratio. Now, technical analysis is a visual representation of human psychology. Fundamentals will tell you the intrinsic value of a business and what it should be valued at. Technicals will show you how it gets there. So here's an example of what I mean. There's a certain subset of people that will buy and sell stocks at round numbers, like $2, $2.50, $5, $10, and that creates a level of predictability. You can see that it's going to be easier to buy a stock when it's coming down at $3.02 compared to $3. Rather than sitting at the back of a massive queue of orders, you can jump that queue at the cost of 1 or 2 cents extra. And same thing with selling. If you're looking at selling something at $5, perhaps it might be easier to sell at $4.97. Now, it's a small premium to pay to guarantee, or not guarantee, but to improve the likelihood of entering or exiting a stock. So let's go through the basics. Trend lines, and that includes horizontals as well. So what we have here is connecting the peaks and troughs of a stock. So if I just clear these trend lines, I'll show you how to draw trends. So what we got here, for an example, is a horizontal. And the charting software I'm using is TradingView, for those of you who aren't aware of the software. So what we have here is a horizontal level, and it's just simply picking the peak of a move. Now, the more significant and the more standout the move is, the more significant it will be. So we also have a peak up here at the top. And when it comes to trend lines, it's about connecting the peaks, and we have an example here, 1, 2, 3, 4. And then we have the underside as well. So we have the underside. Sorry. So the peaks and troughs, and you can do it here as well. So the idea behind the trend line is that the more data points it has and the longer time frame that it develops, the more significant it acts as a level of support and resistance. When it has multiple data points and the longer it goes for, and if it breaks out of that level, the more significant the breakout will be. So here's an example of breaking out of something with 1, 2, 3, 4, 5 data points. When it breaks out, it moves more significantly. Something that has like two points here, shorter time frame, it's less respected. Same thing with horizontals as well. Now, another type of trend line is the horizontal. So what we have here is a gap fill horizontal. So you can see there's a massive gap from this candle onwards. We just draw a horizontal ray. There we go. That's going to be a level that's key. It's called gap filling. It tends to be quite significant as a level of support and resistance. So if we scroll across, we can see it gets respected, and then eventually it breaks out to the upside. Now you might be wondering, well, how does this apply to your risk management that you were talking about earlier? Well, the way I work with technical analysis is I don't simply just open a chart and go, this is going to be long or this is going to be short. For me, it's about identifying a good entry point. And for me, I don't buy stocks that break out. So here's an example where a stock is respecting the trend line and it breaks out. I prefer to buy a stock that comes back to the trend line, to the breakout, to minimize my risk. So I would be looking for an entry around here at $6.72 and having a stop loss below the trend line, giving it enough room that the candle can wick a little bit below so I don't get stopped out unnecessarily. So giving it a good maybe 15 cents of risk. And then I'd be looking for, my first target would be a horizontal, which would be somewhere around here at 755. And then I'd close partially my position at $7.55, and I'd be looking for a next major level. In this case, it'd be just under $9, so $9.04. I want to get below that major level at 9, so maybe something like $8.94 would be my second target. So that's the idea behind risk to reward management and risk management in general for technical analysis. It's not about pulling up any stock and saying, aha, this is going to be long or this is going to be short, right? So if I pulled up this chart and I say, it's bullish, which it is, it broke a major trend. It's not about buying here, because look at my risk. I'm risking now this much to potentially make that much. My risk to reward is less than 1-to-1. It's not a good trade. Now, if I was a long-term trader, I'd be looking at this and I'd be going, yeah, look, in the long term, it looks healthy. But even for long-term traders, why buy here at 721 in the middle of nowhere when you can minimize your risk, right? And this is a common thing I hear from long-term traders is, I'm holding it for 12 months anyway. What do I care about a few cents? Well, if you're willing to wait 12 months while holding it, why not wait 1 month to get a better entry? There's a chance you can miss out, yes, but there's other opportunities out there as well. There's not just one stock, right? You can shop around for stocks. So for example, STO, I would put in on my watch list. I might set an alert, a trigger, and say, let me know when this stock hits $6.80, and I'll consider buying it. I'll set a stop loss. I always set a stop loss, and that'll be my risk to reward. I'd be looking at least 1 to 7 for my risk to reward. So I can afford to be wrong more than 70% of the time and still be profitable, right? On average, somewhere around 50%. But if I'm 50% correct with a 7-to-1 risk to reward ratio, it's substantially more profitable than someone who's, say, 1-to-1 or 1-to-2 for their risk to reward management, or 2-to-1. So I usually aim rather for 3-to-1 or better for risk to reward management. So here's an example of a stock. I was looking at this today, the 4DS. I can look at this stock and I go, okay, so there was a horizontal here and it broke out. It came back to retest and it rallied. Great. It's bullish. Fantastic. You know what? This stock can potentially go to, if I zoom out, you see some levels. Oh, it's got quite a lot to go to the upside. I look at this and I go, right, I don't want to buy in. It's bullish, absolutely. But my risk would be significantly increased if I enter this stock now. I'd perhaps wait around this 17-cent mark to enter the stock. I'd have a stop loss at 15 cents, and that's it. I would have a 2-cent stop for quite a substantial amount of gain, looking historically for the horizontals and for the major levels. And really, there actually isn't too much in terms of technicals for this one. So really, that wouldn't be too helpful picking the exit targets, but I'd at least have a 3-to-1 on this stock. I'd take profits on the way up. So let's say another stock, JB Hi-Fi, for example, JBH. I look at this and I go, right, there's a nice level of horizontal here. There's a bit of unusual action happening here at this key horizontal here. There's a very bizarre action going on there. But we can see on the news day, earnings came out. It clearly wasn't any good. It gapped up above major resistance. It shot up and got rejected on the same day and struggled to hold this level. So to me, that just tells me it's done. I'd be looking for a short. It's already sold off and retested a couple of times. So I'm a little bit late to this one, but it'll be nice maybe a few days ago. You know, I know some people say, this is just hindsight trading, and you're right. Absolutely, this would be hindsight trading. So there's no setup for me here. I would either wait for around $46, or just above $46, with a tight stop loss at $45.50 to swing this stock back up to the upside. That's swing trading. Very, very good risk to reward management. That's $7 profit for 50 cents of risk. That's a 14-to-1 trade. That's what I'd be looking for. So no, there is no trade here at the moment, but I would be waiting for one. We can open up something like Qantas, or actually, let's say Flight Centre. It's a bit more interesting. More people are interested in this one. Now, there's a bit of a range here. That should look more like this. there's a support range here. So it's not just simply one trend line, but rather it's a range because a lot has happened in this area. We've got a horizontal here and we've got a gap fill here. And it looks more like this actually. That's the support level. There's quite a bit here. So I'd be looking at somewhere in the middle of this range or to the bottom side for a swing back to the upside. We can see the horizontal here was respected, but there was no gap fill here at 14.39. So for me, I'd be looking for somewhere in this range with a tight stop loss at 14.16 for a swing to the upside to $18 or just under $18. So that's my risk management, and that's all it is. It's about getting the right entry, defining the risk, defining the reward, and that's my swing trading in a nutshell. It really isn't complicated. It almost looks deceptively easy, and that's because there's a million indicators under the sun, and people fiddle around with these indicators trying to find the golden indicator to try and pick the bottom of a stock, but I think that's a completely wrong way of doing technical analysis. The real-time information is horizontals and trend lines. These are real-time indicators of support and resistance. They tell you real-time where the psychological levels are, where the psychological barriers are, where the support and resistance is. That's what matters. Breaking out of a key level is significant. Catching the retest, for me, is significant. That's how I trade. I don't think it's any more complicated than that. And you guys might be wondering, well, okay, where do you shop for stocks? Well, for me, I have a stock screener. You can set to 52-week high. You can set any of these screens. You can set your own screens. I got some for end of day. I got some based on certain capitalizations. Here's an example, 52-week high. I sort by market cap. And I don't like anything really below 100 million. So I'd be looking for something. That's not really a very liquid chart. I want something with more liquidity. Here's a perfect example of something I was looking at earlier. I was talking to someone else about this risk management. PEK is this stock. It's in the small cap space, more towards micro cap. It broke out on really nice volumes. So we've got a nice upwards channel and we have a breakout on really good volumes, which is quite significant. We want breakouts to happen on high volumes for conviction. And I'd be looking at an entry above this trend line here, somewhere just under 10 cents, maybe 9.6. And it all depends how long it takes to get there, whether it takes a day or two. It could even be 9.5 cents. And I'd want a stop loss around 9 cents. I want to give it a little bit of room. So that's 5 cents of risk. And then I'd be looking at a horizontal that I've identified at 13 cents. So I got 5 cents of risk. And I'd be looking at, I'd be looking at half a cent of risk for 3 cents of gain. So that's about a 6-to-1 risk to reward. Well, I think that's 7-to-1 actually from 9.5. That's 7-to-1 risk to reward. And that's it. So I go back and I don't buy here. I don't buy at 10 cents. I wait for the price to come to where I want it to be to maximize my support, to maximize my risk and reward. Sorry, minimize risk, maximize reward. And that's pretty much it. It's not glamorous. It's not exciting. It's about shopping for stocks, getting the right entry, and seeing what's out there. And I really don't like these illiquid stocks. I like things with a bit of volume and momentum to them. So some of these stocks really do suck. So here's an example. HTG looks okay. Bit of liquid for my liking. IBX, there's nothing there. NMT. Okay, this one's interesting. I'd wait for a pullback, so I'm not too interested in that one. WMA, nothing there. Here we go. This looks nice, actually. A4N. And I have no idea what this stock does, but I've identified that it's broken out of a nice horizontal here, and it's done so on really good volumes. So typically, when a breakout happens on high volumes, the sell-off comes with low volumes. I'd be looking at an entry of about 37, maybe 37.5. A stop loss at 36. So this one would actually be really tight, maybe 35.5. Really tight. So first thing I identify is risk. Second thing I identify is potential reward. And the reward here would be 46.5. So just visually you can see my risk management. And that's all there is to it. I can afford to be wrong so many times and still end up being profitable. So guys, I hope this has shed some light on how I do technical analysis, and I guess defining how to do technical analysis a bit better than just drawing lines and just crystal balling things like some other people do. That's my method. And please do consider hitting that subscribe button if you've learned anything today. I'd appreciate that very much, and hit that like button. Otherwise, that's pretty much it from me today. And let me know what you think. Leave some comments below. I'd appreciate hearing your thoughts. Thanks, guys.